Good morning and welcome to our webinar, The Living Portfolio, a logical approach to containing your investment risk. Good morning, everybody. I'm Scott Bussey with Baring Financial Advisors. The reason we're getting together today is to talk to you a little bit about the concept of keeping your investment portfolio alive, being able to invest systematically rather than on a wing and a prayer. Securities and advisory services offered through VSR Financial Services, a registered investment advisor and member of FINRA and SIPC. Baring Financial Advisors is not owned or controlled by VSR Financial Services. We want to cover a couple of housekeeping items first. From time to time, this transmission might be interrupted in manners we have no control over. So in that case, if it happens, look into your lower right-hand corner, exit full screen, and then click on the refresh button right next to the URL code that shows the address of the web address that you have zeroed in on. It's that round circle with a little arrow on it. Clicking the refresh button will take you right back to the point where you left off. If, however, the transmission is interrupted and you cannot restore by refreshing your screen, we'll try to furnish access to this webinar's replay. Just contact us here at these coordinates and we'll be happy to facilitate that for you. And finally, if you receive a very short survey request from Laura Donahue at the end of this viewing, please know that we'd really appreciate your responses to that short survey. We plan to continue to educate our clients, our financial advisor friends, and investing public ongoing, so your survey comments will help us deliver the most useful content. It's a little bit of information about Baring Financial Advisors, founded in 2002 from a practice that was initiated in 1997. Today, we're a factor-driven, stock-based investment manager, tactically managing investment classes such as alternatives, currencies, commodities, fixed income, U.S. equities, international equities, and specializing in tactical risk management. Let's begin with a story from a book that I read called Why Smart People Make Big Money Mistakes. The authors are Gary Belsky and Thomas Gilovich. By the third day of their honeymoon in Las Vegas, the newlyweds had lost their $1,000 gambling allowance. That night in bed, the groom noticed a glowing object on the dresser, and upon closer inspection, he realized it was a $5 chip they'd saved as a souvenir. Strangely, the number 17 was flashing on the chip's face. Taking this as an omen, he donned his green bathrobe and rushed down to the roulette tables where he placed the $5 chip on a square marked 17. Sure enough, the ball hit 17, and the 35-to-1 bet paid $175. He let his winnings ride, and once again the little ball landed on 17, paying $6,125. And so it went until the lucky groom was about to wager $7.5 million. Unfortunately, the floor manager intervened, claiming that the casino didn't have the money to pay should 17 hit again. Well, undaunted, the groom taxied to a Better Finance casino downtown. Once again, he bet it all on 17. And once again, it hit, paying more than $262 million. Ecstatic, he let his millions ride, only to lose it all when the ball fell on 18. Broke and dejected, the groom walked the several miles back to his hotel. "Where were you, honey?" asked his bride as he entered the room. "Oh, playing roulette." "How did you do?" "Not bad. Lost $5. Now this story, which we now know as the legend of the man in the green bathrobe, is known by casino pit bosses, but now renowned by behavioral economists because it deals with the bedrock principle called mental accounting. Because our newlywed started this evening with just $5, he felt that his loss was limited to just that amount. This illusion of playing with the house's money plays as much a part in why casinos make so much money as the odds that favor them to begin with. Other illusions that innately work against the individual investor come from our cognitive biases as a result of our wiring, the neurology of our brains, and the predispositions that we have to overreact or underreact to things like investing in the stock market. This is what's been said according to the studies in the field of behavioral finance. Here are some examples. Asymmetrical responses to losing trades versus gaining trades. In other words, a losing trade generates twice the emotional intensity as a winning trade. The disposition effect, where investors sell winning stocks too soon and hold losing stocks way too long. Decision paralysis, and countless more behavioral-rooted inclinations that affect and impede our ability to remain rational about our investment portfolios. Now, the Living Portfolio is the name of this presentation today, and that may seem like an odd title to you for a webinar on investing. Well, my hope for you is that by the end of this presentation, you'll come to appreciate that similar to anything else we rely on for sustenance, like a home, a job, personal relationships, we need to commit time, attention, and caring to our investments if they're to fulfill our expectations for them. Neglecting them has consequences. So too do emotion-based decisions when it comes to investing. A logical system, you see, can help you. The goal of this presentation is to equip you with the awareness and the know-how you need to begin using a system tomorrow that'll help you address risk and invest more confidently. Now we'll begin to explain the logic of our systems-based approach by talking about things like investment risk. What is it? How is it managed? Why use risk management to manage investments? Who's responsible for managing investment risk? And what could be a proactive plan used to manage that risk? In our case, we use the DREAM system. Let's further explore investment risk. We'll examine what is investment risk. We'll examine how investment risk threatens the intended outcome of investing a portfolio. And then we'll address how we can address that, how we can address the threats to that outcome. Should we grin and bear it? That's also known as the buy and hold theory. Should we avoid it? Now remember, no risk, no return. Should we try to insure risk? That has limitations too. It also has costs involved. Should we be adaptable to it? That sounds possible. Let's see how our industry defines investment risk. FINRA refers to investment risk to be synonymous with systematic risk. And they define systematic risk as the risk from events that cause all stock prices to fall. They further go on to say that diversification, at least among risk-on or growth asset classes alone, does not work. The only real defense is to lace a portfolio with certificates of deposit and fixed return, fixed yield, fixed maturity assets, like bonds. And after 6,000 more words circumnavigating the subject of investment risk management, FINRA admits that modern portfolio theory, which we all know as the buy and hold strategy, is the industry standard for dealing with investment risk. That begs the question, doesn't it? Does a one-size-fits-all approach seem like the right way to deal with each and every client's unique emotional and investment makeup? There are a number of different risks that we can talk about that involve, that affect our investment portfolios. Cognitive biases, which are based on the baggage that we carry, our emotional baggage, our expectations, our hopes for favorable or a fear of an unfavorable investment outcome. But we rely on what we call heuristics, or rules of thumb, that we think might help us in making decisions about investments. Another risk would be inflation risk. And this is a risk posed by a portfolio that has assets returning less than the inflation rate. For example, 2.75% inflation rate. We own a bond that pays 2.5% interest after taxes. We're so far below the inflation rate that what really happens here is we wind up with a negative real return. Our buying power of that portfolio actually diminishes. Another risk is timing risk, and this focuses on the likelihood of negative events occurring at the wrong time, like retirement or a black swan event. A black swan event is an event that occurs in a manner that deviates far beyond the range of normal expectations, and such that they actually change our perception of reality. The stock market's behavior in 2000 and 2008 would certainly foot the bill as a black swan event. That leads to situational decisioning, which is how we change our tolerance or our outlook, thus the decisions we make based on recent year or recent time period's performance. And finally, portfolio failure risk, where investment performance is insufficient to keep up a retiree's portfolio from depleting its asset base. This happens when withdrawals continue to be made to meet the retiree's cost of living without adjusting for subpar investment returns. That's also referred to as excessive withdrawal risk. And timing risk is also known as point in time or sequence of return risk. Now, we've identified a few forms of investment risk. Next, we're going to look at how we can put a plan together to manage the risk. So let's first define investment risk or investment risk management. Risk management has been defined as the identification, analysis, and acceptance or mitigation of uncertainty in investment decision making. That definition revolves around the word uncertainty. Uncertainty of outcome of investing. Will it go up or will it go down? How far up or how far down will it go? How long will it take if it goes down to come back up? These are all uncertainties, and we want to identify and analyze those uncertainties, and therefore from that analysis decide to accept or mitigate the risk in how we make our investment decisions. And finally, by the end of this presentation, we'll be able to put our own brand of investment risk to management to work for you. Now, the next slide gives us a basis to quantify the magnitude of the risk. In other words, how bad can it get? We see here a table of research done by Ned Davis Research covering the period of time from January 1928 through April of 2012. The stock market in this case is described in terms of performance through the Standard & Poor's S&P 500 stock index. And here we see the corrections in order of magnitude, beginning with what they call a dip of 5% or more, moderate correction of 10% or more, severe correction, and bear market. We'll focus on the two right-hand columns for the moment. What we see here is that a severe correction of 15% or more has happened on average a half a time each year, or one time every other year. The average period of time it lasts is 191 days, a little over 6 months. The average decline is as much as 28.25%. A bear market, where we've seen the S&P 500 drop by greater than 20% in value, happens every third year, lasts approximately 10 months, and the average decline has been 36% during those kinds of events. So how does this affect us? Why is this important to us? Well, the next slide indicates what we call a problem based on the sequence of returns. And in this particular case, what we see here is a calculation using this formula here that shows that if the account drops by value of 15%, it will take a rebound of greater than 17.7% off the bottom just to get back to break even. A 20% decline would need a 25% return off the bottom just to get back to square one. And a 25% decline requires a 33 1/3% return before we're back to break even. So this would actually indicate to us that we're probably going to have a pretty good wait of time, or a pretty good period of time to endure before getting our value back to where it was before the big dip. Let's now take a look at the calendar pass where we can view an actual decade of investment performance. We'll see how the magnitude, the timing, the recovery percentages come into play. Imagine, if you will, a couple retiring in January 1 of 2001, and for their investments in stocks, they and their financial advisor agree that an assumption of a 7% annual compounded return would be the norm. Compounding annually over a 10-year period of time, that $100,000 in equities would grow to over $196,700. How did it go? Well, the good news is, over the first 10 years of investing, 7 years were up years in the stock market, while 3 of them were down years. The problem is that due to the fact that those first 2 years were down years, and to the extent that they were down years, they caused a drag on the performance of this portfolio. Rather than ending up at $196,700, they wound up with a value of $116,700, a shortfall of 80% over a 10-year period of time. An annual compounded rate of return equivalent to 1.56% rather than 7%. To add insult to injury, if they had just merely invested in money market returns, the portfolio would have gained 1.23% over that 10-year period of time. Now, there's not a whole lot of life in a portfolio that languishes like this over a decade. So we now need to ask ourselves, or face that question, do we choose to accept or mitigate the risk, or do we, again, sit by and hold and hope for the best? Here's another question associated with that. Could we come up with a plan to avoid this from happening? Do you have a contingency plan? See, a contingency plan is something that you can rely on when things break down. Seriously, how should we approach building a plan to manage this investment risk? Let's begin by establishing a few absolutes as guiding principles. First one is proactive management is better than reactive. That's a good place to start, because having a plan that you don't need is better than not having a plan that you do need. The second guiding principle is a responsibility is not limited to just the investment manager. No, that is the case. It's not limited to the investment manager. If you are a do-it-yourselfer investor, you are the investment manager. You are not farming that risk management out to a mutual fund manager or an ETF sponsor or to a third party unless you explicitly contract with that party to do so. If you have a financial advisor, you need to have two-way communication, make it very clear who's responsible for managing the investment risk. If that financial advisor hires a third-party money manager, you need to make it very clear what your expectations are, who will be monitoring, and who will be managing the investment risk. And finally, if you can't assess the risk of an investment, you probably shouldn't own it. Or at least admit to yourself that you're a speculator in that regard. You're not necessarily an investor. And that advice I would give to you would be to make sure that you've weighted that particular investment down such that an adverse performance period of time or a really negative drain on performance would not necessarily weigh down on the overall value of your investment portfolio. And finally, at least at Bearing Financial, we agree with the view that a risk management framework should be aligned with client objectives, client expectations, and client investment horizons. In other words, a risk management framework that reflects each client's own personal circumstances. So our framework is built on a proactive, quantifiable, and systematic system. We call it the DREAM system. It's a risk management model, and here's how it works. The model downloads market data nightly, more than 36 market data elements fed into 9 key indicators. 3 are long-term indicators, 3 are middle-term indicators, and 3 are short-term indicators. Based on the updated data, the 9 key DREAM indicators are coded according to risk classifications. Based on these classifications, the model will then prescribe to us any one of 4 settings to cap the level of equity investments we hold. The 4 settings are full offense, or 100% of the client's client-specified maximum equities, full defense, or 25% of the client-specified maximum, and then 2 points in between, 75% and 50%. Now, for the sake of today's discussion, let's focus on one of the DREAM indicators called bullish percents. This is an intermediate indicator, and a bullish percent refers to the percent of stocks within a given universe that are on buy signals. For example, if 450 stocks out of the 550 stocks in the S&P 500 are on buy signals, then the bullish percent for the S&P 500 is 90%, or 90. 90% of the stocks, 450 on buy signals, 500, or 10% are on sell signals. We use the bullish percent to measure risk and also for measuring the competing forces between supply and demand for stocks in the markets. We're going to take a look at a trend chart here for a bullish percent, in this case a little larger universe of stocks, the New York Stock Exchange stocks, over 2,500 stocks, to see how we track that bullish percent. The vertical hash marks shown here are the years of 2007, 2008, 2009, 2010. The left-hand scale indicates the percentage of stocks that are on buy signals, or the bullish percent. X columns show movement up, or demand for stocks, where O columns show movement down, where supply overwhelms demand. Columns are also, we'll see numbers in there. 1 through 9 is January through September. ABC is October through December. What we see here is in February of 2007, here's the number 2, February of 2007, 74% of the stocks in the New York Stock Exchange were giving off buy signals. And this third column here indicates that in April of 2007, 74% were giving buy signals. This highlighted mark here, this X, indicates October of 2007, where 62% of stocks we're giving off buy signals. If we were to look at just the bullish percent chart here, this is a bullish percent trend chart, we can see that something negative is happening taking us into the year 2008. These columns right here would indicate to us when we needed to exit stocks as a standalone indicator. We see demand entering back into the marketplace only to see a huge exhale or soon an oversupply of stocks meeting in the marketplace. There's September of 2008, and there's October of 2008. In October of 2008, we actually saw a low of 4% of the stocks in the New York Stock Exchange, only 4% giving buy signals, 96% giving sell signals. In November, we saw that increase to 8% on buy signals, and in March of 2009, we saw actually an improvement, a higher bottom at 14% of the stocks giving buy signals. In October 2007, the S&P 500 was at 1562. In October of 2008, S&P dropped to 840, a drop of more than 46%. And in March of 2009, where we actually saw what appeared to be demand coming back in for stocks, the S&P 500 dropped another 10%. So the headlines were full of bad news and reports of market mayhem. All the time, the bullish percents between, once we hit the bottom, we saw an increase to 4% in March. So on March 19th of 2009, the Dream System actually told us to double our equity exposure. By July of 2009, we increased it to another level, and by September of 2009, we were at full offense. The irony of this Dream System is that it was inspired to save our clients from financial ruin. But at a time like this, it gave us the confidence we needed to get back into the stock market. Though the bullish percent was rising, all common investors out there in the marketplace were bailing out. They reacted to the headlines, and we chose to do otherwise. So, from this picture, let me ask you a question. When it comes to tackling investment risk, are you going to decide to use a plan, or are you going to set yourself apart by relying on a logical system to address risk and keep your investment portfolio alive and viable? You can do that by managing not risk, but the exposure to that risk. Our plan is the Dream System. No system's perfect. When the Dream System isn't right, it's going to correct itself back onto the right track. It's not about market timing. It isn't predictive. It's trend following. It measures risk levels in the equity markets, and it prescribes the corresponding limits to exposure to that risk. We don't base this on emotion. We don't make our decisions in investments based on emotion, but evidence. Now, I promised you you'd be ready to put the Dream System to use in your portfolio or your book of business if you're a financial advisor before we wind this up. So let's see how that might work. This is a graph that depicts the changing levels of exposure to equities for investors of various risk tolerances. A TMA5 A TMA5 is an investor who owns a tactically managed account that will own as much as 50% equities. A TMA9 would be a tactically managed account capped at 90% equity. These changes in colors, these breaks in colors, indicate the changing levels of the Dream System at full offense, full defense, and 2 points in between. We call it bull cycle, bull watch, bear watch, and bear cycle. So for us, our investment process is broken down into 5 different categories. First, determine the risk tolerance of our clients. On a scale of 1 to 10, this will indicate what their maximum exposure to equities will be during the best of times. Second step is to apply that risk management code. The third step would be to just simply determine whether or not they want to have active risk management engaged. Check the box, yes or no. The fourth step is that we'll manage the equity levels according to the DREAM system, which is announced, which announces its updates on Twitter, as well as our homepage, our website homepage, which will give us the notifications of what level of offense we'll be on. And the fifth step is to tactically manage our accounts to stay in the strong relative strength asset classes and avoid the weak on a periodic basis. Now, in 2012, we saw a very active year. We actually saw the DREAM system change 12 times. In 2013, however, it changed once. In January of 2013, it went from bull watch to bull cycle, which had us at a full offensive level for the entire year. In 2014, halfway through the year, we've seen 4 changes. The DREAM system now sits at 100% offense, so we're fully deployed to the maximum extent allowable per client. Now, I present the DREAM system in this way so that you can envision how you might manage your portfolio if you're a do-it-yourselfer, your book business if you're a financial advisor, or certain segments of your investment book, i.e. annuities versus taxable brokerage accounts, or taxable brokerage accounts versus tax-deferred accounts. There are a number of ways that the DREAM system can be applied to help you manage your client or your portfolios better. As we said, we can incorporate the discussion about risk management in a client investment policy statement and clearly indicate whether the client chooses to have risk management or not. Another application would be when we do our periodic 401k allocation and rebalancings. We also adjust our clients' annuity allocations and rebalancings on a seasonal basis. It pops up in new client acquisition opportunities when a prospect sits in our office and asks us, okay, what are you going to do if the market crashes? To that we say we have a system called the DREAM system, which systematically gauges the changing levels of risk in the market and applies the limits of our exposure to that risk. Adding new investment dollars to existing accounts is another use for the DREAM system. We have systematically applied risk management across a couple of different brokerage account platforms, and there are a number of different ways you can use the DREAM system according to your own individual needs or your own investing system. Now, since 2007, our mission's been to save our clients or friends and family from financial ruin. To do this, we want to keep their investment portfolios alive and thriving. Do you have any questions about the DREAM system or how it might be able to help you? I'm happy to discuss our experiences, our approach, our techniques, our methodologies with you specifically. Feel free to contact us or me at these locations. The DREAM system on Twitter will provide periodic DREAM updates, including level changes and explanations for it. Follow my commentary on Twitter at Scott Bussey. And again, at BearingFinancial.com, you'll find company information as well as the DREAM tweets if you can't find them directly on Twitter. At this point, I want to thank you very much for participating in today's webinar. Please let me know what I can do to help you be a better, more effective, less emotional investor. Don't fear the market, and have an awesome day.